I think what's interesting about this moment is that this is the most poked and prodded economy that I've ever seen. Every data point seems live and important, but it's not, it's sometimes a cacophony. And what we're looking at ADP, we're going through to what we think is most important in this economy, which is how companies hire and what they pay. And that has changed significantly over the last 4 years. We've seen shifts in geographic distribution, so people are commuting long distances. That has an effect on pay. In fact, we find in our latest report, it's out today, that people who actually go the distance for employment make 16% more than people on their own teams. So that's a huge change, and it's under-examined in this market. We're seeing pay distribution change, the gaps between the wealthiest workers and the lowest paid workers has grown by our estimate 5 percentage points over the last 4 years. We're seeing occupational changes where software developers, which should be an in-demand job with all of this talk about AI, there are fewer software developers now than in 2018. And then, of course, for all of us who have teenagers, summer hiring is in focus. The summer looks strong in terms of jobs, but not so strong in terms of pay for these young people. So all of these shifts feed into the narrative and the distribution of the worker, not something we talk about a lot lately.
And I guess that's part of the reason why the data has been confusing, because there are these structural shifts that doesn't necessarily show itself on a headline level. So what do we do with the data then? Should we just ignore it? Should we discount it because things are different and what it's telling us isn't really what's happening under the surface?
We can't discount it because we know that a certain really important institution is pegging a certain really important decision on the cacophony of data points. But that one move won't shape the economy. Whether you lower interest rates by one dip this year, 25 basis points or 2 or 3, really won't change the distribution of the U.S. workforce, which has shifted. And I think that's what we're seeing in the data. That pay change, this low level of wage growth that was really keeping the economy on track during the 10 years of expansion is not here now. That pay is changing, it's evolving, and that evolvement in pay means that inflation may go up, may be higher for longer, and the Fed always has to be watchful on this data point and on pay in particular.